Abdoulaye Ndiaye from NYU Stern. Abdoulaye works on issues at the intersection of public finance, development, and political economy, particularly topics related to inequality, state capacity in African countries, and the relationship between finance and social movements. Abdoulaye's talk today will focus on quantitative macro analysis of tax productivity and development. Thank you, Abdoulaye. Welcome. You have 25 to 30 minutes.
Thank you, Q, Campbell, for having me and everyone at this great conference. One thing you didn't mention is macro. Maybe macro is sometimes a word not to utter too much. But I'm the one today to present a little bit of macro here and the second Anders paper. So this is joint work with Radhika, the IMF, Anders, David, and myself. And Yuntian is a grad student of mine at NYU. So like we have seen in many of these talks, I don't think this is an audience to convince them that tax collection seems to have an important role for development. It is very central to state capacity theories of development. There is a lot of theories of political economy, how to think of this, bringing in the role of reciprocity, bringing in the role of tax collection as a social contract, the idea of appropriability of Machar, Mauve, and Pascali, of having technology that makes it appropriable resources that's good for state development since the ideas of Tilly. And even before that, in 1800 England, 18th century England, Adam Smith, who has spoken about so many things, including taxes as well, said, quote, "Every tax ought to be so contrived as both to take out and to keep out of the pockets of the people as little as possible over and above what it brings into the public treasury of the state. The cost of collecting it may be very considerable and in worst cases may amount to more than it brings in." So this is an audience where people care a lot about the cost of collecting taxes. Macroeconomists haven't shown so much. So what the goal of this project is really to answer this question, to bring more light and to contribute to the discussion on what is the quantitative importance of tax collection capacity. How does it matter? Once you start some of the interventions you have seen here today, if you were to scale them at the level of a country, what would be the impact on growth? That's an important thing we're going to address. So in this project, what we do then here, so today I'm going to show a subset of some of the elements, mostly the data that we collected, also some of what type of model we write to make sense of the data, and in the end, how do we use the model? So first, we propose a new measure. We have seen here some measures of tax to GDP. GDP is an endogenous to production process. So we're going to say, okay, we think we have a measure that's a pretty good measure that we want to propose as a measure of tax collection capacity. What is this measure? So looking at data from tax revenue authorities across 100 countries, we take this measure, which would be taxes collected, divided by how much is spent on the tax administration, okay? This T over X, all right? I'm gonna document that it is positively correlated with development, okay? GDP per capita over the cross-section of our countries in our sample, historically for the US case, and also even when you look at local public finances across US states and across Indian states, right? So macroeconomics, when we see a very striking figure like the one I'm gonna show you, we wanna write a paper about it. So what we do next is we're gonna say now, okay, there seems to be this very nice correlation. Is there a model that can rationalize it? And can we then use this model to think of what should be the optimal size of the government in terms of tax collection? And that's what we do. Now, in terms of doing this, we have heard some names here mentioned already, like Ramsey, Diamond, and so on. We are going to consider a general equilibrium model. A general equilibrium model just means that we want to make sure that government internalize household behaviors and that households as well internalize that the government will potentially respond if they change their behavior as well. Now, most of this literature haven't done what we have done precisely because they were interested in very important questions, we think, like such as what should be the right tax base. But when we think of development, we want to go beyond that. We want to just beyond answering questions such as should we tax capital or not, but what is going into taxing capital And we have seen here discussions about statutory rates are not the same as effective rates. So in our model, we're going to capture three elements we think are important to match, to have this development process. So what do we add to this Ramsey model? One is that we're going to have a tax administration sector like people in this room have studied it. We're going to have people, you're going to hire tax collectors. They're going to go in the ground and they will collect more taxes. What do these taxes go to? Okay, there can be some loss of these taxes due to corruption and other uh, constraint, but very importantly, they will build infrastructure. They will build public capital, which makes firms, modern sector firms, more productive. Okay, and so here we're going to use the workhorse models that the World Bank uses, the World Bank long-run growth model, to think of this as well. And then taxes do not come for free. They will have the usual distortions, behavioral effects, effects on welfare as well, so welfare effects, but also very importantly, they will have also effects just on the production nature as well in the economy, is that if you tax the formal sector too much, they will then go and move into a traditional sector, okay? So, and evade taxes. So these are the important features that we have to make this story quantitative. So let me summarize our results, our conclusions so far, which is the first thing. So first, when it comes to the data, tax collection relative to expenditure is increases in GDP per capita, so it's positively correlated with the process of development, so that's our fact. Second, we can produce a model, a quantitative Ramsey model that helps match and reconcile the cross-country patterns. In particular, we see important differences to the same order of magnitude of differences in terms of the best firms, modern sector firms, productivity differences. We see equally important differences in terms of productivity in tax collection. Okay, so productivity thought in a macro sense is like just TFP, total factor productivity of tax collection. And quantitatively now, what we find, we're looking at a counterfactual, which is what would happen if you were to scale up some of the, find a way to scale up and increase productivity in tax collection. And we find that you have an order of magnitude larger than what the growth accounting that macroeconomists are familiar with, which is that if you have a small sector of the economy and you have growth in that sector, on net, the first order effects are not that large. It's going to be the size of the sector times the growth in that sector. Here we're going to argue it's going to be an order of magnitude more for many reasons because it's like a bottleneck sector essentially. Okay, because infrastructure is very important, especially at the early phase of development. All right, so let me now go over some of this, showing the data, show what type of model we're going to have, and then show you some of the results of the model. Okay, so empirics. So for the empirics, our unit of analysis will be the Ghana Revenue Authority or the IRS. Okay, so the Ghana Revenue Authority will be at the national level or the IRS. Here, Anders also, this is the Anders conference, have done a lot of work into getting this data sorted. So what do we do here? So we're gonna take these documents. So now, in terms of our measure, what's gonna measure 100 countries, 625 country observations. So these are like PDF documents that are buried into many different websites. Some of them are in different language, Italian, Arabic, and so on. The taxes collected, this is something for which we have a lot of pretty good data overall. You know, IMF has data on this, personal income tax, corporate tax, VAT, and sales tax. But the most full effort in terms of data for us has been also the tax collection, the expenditure on tax collection. And the large majority of this expenditure, as we know here, also is personnel expenditure. Okay? So we divide these two, and we propose this as a new measure to think of tax collection capacity. So let me show you how this measure looks like, okay, in terms of the gradient we see. So if we look at here, GDP per capita in current US dollars per thousand on the x-axis, and we look at in log scale taxes collected of expenditure across different countries or sample, this is what we have, this positive correlation. So how do we read this figure? The way I read this figure is that, for instance, if you look at there, whether it is Sweden or the US, okay, for every dollar you spend on collecting taxes, so these are averages, you will collect on average around $300, okay, that you will collect in taxes. Whether it's the Sweden or the US, and I can show you also that these are not just driven by just the statutory rates, okay, that the Sweden have larger statutory rate, because both the Sweden and US. And at the bottom here, for our, for instance, lowest in the sample is Burundi. For every dollar spent on tax collection in Burundi, you collect on average $30. So it's an order of magnitude larger. The marginals as well are important, but these marginals are mostly studied on a case-by-case basis using RCTs. And you have here some middle-income countries as well, Brazil, Ecuador, etc., that are somewhere in the middle. Okay. Now, this figure, you can think about it in many different contexts as well. I'm going to just show you a little bit of more robustness. Of course, this is just correlational. Okay, we're not claiming beyond that. That's why we then go and use a model. So let's now just convince you that we do our job right, because these governments across their tax administration, they do different things. So if you look at this correlation, how it over our whole sample, if you take low income countries, it's a stronger correlation. Okay, and so that's why the title of this paper is development, tax productivity and development, not growth. Okay, because I'm going to show you, we'll tell you our story exactly. This is not a paper about what is the size of the government multiplier. Should we expand the IRS today for the US? Okay, but for countries that don't have public infrastructure at the very phase, we argue that, or our papers suggest that it's pretty important. When you take middle income countries, the correlation becomes lower, and we can control for the fact that for the personal income tax, VAT, or corporate income tax, because different countries at different levels of their development have relied on different taxes. Now, you might be concerned that some administrations, for instance, in their expenditures, are doing more than just collecting taxes. Like some are they are in charge of Social Security, so that's more expenses, or some are in charge of the population registry as well, right? Because then you need the people to go have the census. Even if you will exclude those as well, so this is like 2 countries in our sample, and this is 27, you still have this result survives. That's our interpretation of this table. All right, so now let me talk about the US case and how this phenomenon of tax productivity, how should we think about it over the US history. So here, this is for transparency to show you what happened in the US case. So around 1850s, okay, so 170 years ago, the US was at the level of Burundi here, which is on average, for every dollar spent on tax collection, you collect $30, okay? Now, gradually over time, so this is a process that takes time, the US have increased its tax collection to expenditure. There have been some episodes that are more of a transitory shock, okay, to respond to. So what is this jump? This was just the First World War, the war effort. You're able to just get more out of the people, but it's transitory. You see, we come back down. And what is important also is after the Second World War, you have withholding at the base. Okay, so withholding at the base was instituted at the Second World War, and this is something that the US being able to enforce, that we interpret it as more productivity in tax collection. Then in the 1960s, it kind of flattens out. There is also some force here happening through the Reagan years in the 1980s, where you have lower statutory rates, but overall we can argue that it's essentially flat. But this part, we argue, is very important, and most of the countries in our sample are in this earlier phase. Okay. So now, so that's the historical component. Now let's talk about across for local public finance. So across US states, we see also, so we do the same thing across US states, and we do the same thing across Indian states. Across US states, we find a larger effect here. This is something I haven't had a chance to talk about with Anders yet, but our interpretation here is that there is more variation in the US between blue states and red states. Many of the red states have no income tax at all. So that's why you have a larger effect here relative to India, for instance. But we still have the same correlation between GDP of each state and taxes collected of expenditure. Okay, so given these facts now, then we're gonna write a model. And how are we gonna use this? We're gonna write a model to make sure that using our sense of taste, the model captures reasonable elements for this. And then also we're gonna make the model match the data, okay? Taking some parameters from the literature and some calibrating them internally. And then we're gonna look at what does the model infer when it comes to the underlying productivity in tax collection, okay? And what would happen if we were to change that? All right. So for the model part, I'm just gonna limit myself to this slide because this is not just a macro talk. And I will then kind of explain just why what we're doing is even relevant, why is it useful. So first, like I was doing some sort of explanation of what this literature has been discussed. So there have been papers that have been debating whether we should tax capital or not. Okay, and I think this is related to what Lucy Martin mentioned yesterday also, that if you have, when debt is available, right, it's not obvious that it interacts in tax with taxation in an interesting way. Many of these papers find that you shouldn't tax at all. You will just like tax the initial capital stock and then borrow when you can to finance yourself, right? So limits on the extent to which you can borrow is important, and that's we built that in our model as well. The John Bates Clark Medal of this week, Ludwig Strobe, have clarified some of the discussion around these models had to do with technical things, whether a steady state existed or not. We make assumptions to make sure that for our setting, there exists a steady state, it is well behaved, and we can quantify this model. So these works have been mostly limited themselves to see whether we should tax capital or not. And I think it's in this room, particularly, can agree that we want to ask more clear questions such as how and to up to what point, right? What should be the optimal tax rate? So we do a few things. So we introduce the tax administration sector. The way we do it here for our first paper in this, we think of just, we're gonna hire more tax collectors. This will give you the tax rate on the wage bill of the modern sector. All right, so we're not gonna assume there is no statutory tax rate. It's all gonna be about how much you can enforce this. We're gonna have A here. A would be an exogenous parameter, and we're gonna think of this, it captures tax collection capacity. Okay, this is gonna be what we're gonna be interested in, is to infer what is going to be the differences between these tax productivities of the different countries. Now, taxes now here are used to make firms more productive. Firms use their own capital, private capital, so machinery. They also hire workers, and they have their own AM here, which is the usual total factor productivity we are familiar with, but they benefit from more public capital, roads, infrastructure. This is also related to the idea of benefit-based taxation. Here in particular, the benefit here comes from making firms more productive. And for this production function in particular, we're going to use what the world uses, which accounts for corruption, that some of these taxes will be trying to build infrastructure, but there will be some losses. All right, and we're going to have relocation from the modern traditional sector. Now, I'm going to skip all of this to just kind of get to how we're going to use the model. So in our model, let me now just explain one part, which is going to be what this model allows us to do. So the way we think of this model, this taxation here is just one example, but you can think of how to have a Ramsey model or optimal state capacity, okay? Which is a dynamic model. And the dynamics matter here. On this here, what I'm going to tell you is what is the optimal size of the public sector, LC. So you're going to have on the left-hand side quantity that is increasing with the size of the public sector. And on the right-hand side, you have these two objects. So what is the intuition here? And the intuition is is actually very simple. Because what it is, there is a race between public capital and private capital. When you start a firm, a country that doesn't have much public capital, so there is just one main road, what will happen is that the marginal product, so F here, G is the marginal product of public capital, okay, will then be very high relative to the marginal product of private capital. So in a world like that, then you want to start then taxing more to build the public capital. Okay, but at some point, okay, like maybe in the US case that I showed you, the marginal product of public capital will not be as important as the marginal product of private capital, so you will then stop. So that's what determines the trade-off between hiring more tax collectors versus less. Another element is also the effect, indirect effect on wages. Okay, by making the economy overall more productive, this can raise the wages of the modern sector, and that also is another force for hiring more tax collectors. Okay, so that's how here the optimal size of the tax collection. Yes, yeah. Yes, you are. The corruption is going to be when we quantify it. Now, let me go. So, corruption is going to be here, right? So Shalkat's colleagues also have developed this. So I'm going to make a specific functional forms here. So, we're going to have decreasing returns to scale in terms of tax collection because the marginal cost of collection also are important. And you can see, and I will show you how we discipline this. In fact, the marginal cost can be pretty high. So that's why we have this eta here, less than 1. Okay, I'm going to show you how we discipline. We're going to have 3 parameters mu. Our production function for the modern sector, so we're going to have complementary between public and private capital. Zeta here is going to be the elasticity of output public capital. And regarding your question, Michael, theta here is going to be not all public capital is going to go through this, so theta is going to be less than 1. Okay, and that's like, they call it the infrastructure efficiency index, and we're going to have 1 for low, middle income and high income countries. Okay, so we're going to have both welfare effects, behavioral responses, all that by having nonlinear preferences in consumption, isoelastic distribution of labor. Okay, so there are 3 parameters, and I'm going to just convince you here what macroeconomists do sometimes, which is called calibration. Well, so the full calibration has a lot of targets, okay, have a lot of, yeah. So the full calibration has a lot of targets and we target a lot of moments, but I'm just going to focus on a few parameters and where we rely on the shoulder of the giants here. So ETA, the way to interpret it is what is the marginal product of tax collection over the average. Right. So essentially what is on the margin, taxes that you're going to collect per dollar, okay, and the average. So for instance here, so Jandy, Anders again, and David, my co-author, they went to Ghana and then they look at what is the marginal dollar that you're going to collect, okay, not the average. So the average we have it from sample. So in Ghana, for the experiment, the marginal dollar, they collect $1.56 for the margin. That's why you end up stopping at some point because it's not worth it that much. And there is another paper also that finds 1.6. So this gives us an eta of 0.04. Here, this was in Costa Rica. They looked at enforcement. It's a different thing, but property tax, people who are not compliant. Again, they have here a marginal dollar of 4, richer country, but an average, so give us eta 0.6. So this is Ben Sperger and others. This is in the US case. This is the IRS audits, okay? The marginal IRS audit here for $1 spent on the IRS would give you around $13. So this makes us that this scale, we have strong decreasing returns to tax collection because of this eta of 1/20, okay, of the marginals. All right, now, another parameter, which is not a main contribution of our paper, but it is still important for the quantitative results, is going to be what is the elasticity of output to public capital. Now, for this, there are few things. One is there are the World Bank is very interested in this and have run meta-analysis on this specific issue. So and we are doing more work on this specific issue to get it, because when you look at the meta-analysis, many of these papers are published in certain venues, and we're not sure whether they fit into the type of peer review process we know, but they find a range of numbers. Some of them here are ones in which they say, oh, actually public capital decreases GDP. So this is the Doge papers. This is the Doge papers. You have a range, but the median here is around 0.17. So what I'm gonna show you today is that would be our kind of our conservative estimate. People like Valerie Rami, who is a macroeconomist, thinks that it's larger, but this is in the US case, so that's 0.42. And they're looking at the expansion of railroads in the US. We're gonna also play with that one. And this one with the infrastructure efficiency index of 56% efficiency, 74% efficiency in middle, and 84% efficiency in the in high-income countries. Okay, so first, how does now our model then perform? There are a lot of parameters others that we target bunch of moments to get them. So one of them, the moments, is going to be across countries matching the tax to our data, okay? Our model does well in matching this, but this is a target, so it's expected that it's gonna match well. Now, how is it gonna do in other dimensions, and what are the implications of our models for tax productivity? So what we find here, so this is GDP per capita, and this is the TFP term in tax productivity. The first thing we're gonna say is our model infers also that there is variation in tax productivity in the data, and that this variation also corresponds also with richer countries to be more productive in tax collection. Okay, so it's not just the scale, right? The decreasing return to scale, but they are also more productive in tax collection. So that's one first thing that we're gonna say just from the baseline. The second thing now is how does this productivity of the public sector compare to productivity of firms? Okay, so that's what I'm gonna show you next. This is going to be AM is the TFP productivity of the modern sector firms. Now, you have a similar order of magnitude of productivity difference in the tax collection sector and firms in the modern sector, right? Now we know productivity differences across countries are even larger. It's a magnitude of 1 of 20. And a lot of that has to do with composition. Like poorer countries have a larger informal sector share, okay? And so that will have then larger difference. But if you look at now, the modern sector firms, so if you take a KPMG in New York and KPMG's Dakar, for instance, that's the comparison I'm saying here. So you have the same order of magnitude of productivity of these, the modern sector firms and the tax collection sector. And I think that's an interesting thing telling us that, yeah, tax productivity then matters. In terms of like now tax to GDP ratio, which is the usual measure that people usually do, our model performs reasonably well, but misses something. So for instance, here, it predicts higher tax to GDP ratios than in the data. And this is something as well, we can do something better to match this component. Okay, and lastly, I think I have 2 minutes, which is going to be doing the following, and this is something that I can sell very well to this class. We have seen at least 3 talks for now where we do something similar to this. So here, what David, Anders, and Clark have done here, which was for collecting taxes, property tax, you go and have a cadastre piece of paper to find the house, and you come and ask a person here kindly to show you where they are. Instead, here you give the people an iPad with the place, right? So this is typically, we argue, a productivity treatment. The question would be now, what if you scaled something beyond this? And I'm plugging also here some of my work as well, where we do something similar in Gambia, putting an addresses system and having people as well go and for also administration of public goods as well. So if you were to scale interventions like this, what would be the gains in terms of GDP, all right? So that's what we are interested in. And for that, I feel like a model can be very helpful. So what do we find and what do we read this table? So in this table is going to be, we're going to take the AC and exogenously increase it by up to 50%. So this is our baseline. This is the GDP change we have. This is for our conservative estimate of the elasticity of output public capital. The main read here that we have would be, if you were to do what people do in terms of sectoral accounting of growth coming from a sector, such as, let's say, imagine there is a financial sector growth of 3%, so our financial sector is 20%, then the growth would be 3 times 0.2, 3%, so we get 0.6%. Now, the public sector, we don't have the assumption we take usually is that they are measured at the input level. For instance, medical, if the government pays for medical care, even if it's a lower cost, that's going to be the miss. So we're going to do here two measures of it. One is going to be at the input, which is the wage that the tax collectors get. If you were to just impute what would be the increase in GDP coming from that wage, it's an order of magnitude less than the GDP growth that we're having. And if you were to look at it from like the taxes just collected, it's an order of magnitude also less. So the reason has to do with the fact that the firms, we're collecting more public capital, but also firms now can benefit from that due to complementarities. They can now invest more in capital and hire better workers. If we now take even a more optimistic estimate, we find much larger GDP gains. But beyond both things, it remains and holds that what we want to emphasize here is that the order of magnitude larger gains, because the tax collection sector is one in which can provides public capital, which then makes firms reoptimize. And one thing that we're working on now is for our kind of final numbers to do a growth decomposition of what is coming from having a larger modern sector, formal sector, capital reoptimization, and labor market reoptimization. Improving corruption certainly as well can help as well. But despite even the corruption level we find, still collecting taxes are efficiently is important. So in a nutshell, what our quantitative conclusions are, inability to collect taxes may be a barrier to development, and we needed a quantitative model to make this when it comes to development. There is new cross-country evidence that we propose this measure, taxes relative expenditures, correlate strongly with development, and we can build a quantitative Ramsey model to rationalize this, and shows that there are outsized gains from raising tax collection capacity, and we are working on our continuing work to match better the tax collection size and having different versions of models with different instruments. Thank you, and I'm here if you have any other questions.
Thank you, Abdoulaye, for a brief digression into macro. So we have time for some questions. We'll get going with Augustine, and I'll come around to you, Barak.
Thank you. Super interesting. I was curious from the data on the pattern, what share comes from T increasing and what shares comes from X decreasing? And then within that, I'm also curious just descriptively of like, when T increases, does it come from rates? Does it come from switch in instruments? And so, yeah, having that would be interesting.
So I'm gonna show you rates first, and then I will let also Anders add more to this, okay? So let me show you on rates to kind of, and we are gonna just, can I click? Can you please click on the statutory tax rates? No, it's okay. It's actually interesting to see.
Well, I mean, you might want to escape. You can, if you hit escape, it might work.
It's fine. I have it.
Okay.
Okay, here. So these are the statutory rates of different tax instruments. And the band is our whole sample. So most of our country, even up to middle income countries, so the GDP per capita in US dollars. So most of our poor countries are here. Here you have some middle income countries. Only the very rich are here. So this is log scale again. you see here, for example, the top person income tax rate, VAT, or corporate income tax, in all of these bands, there is no meaningful difference here, okay, across this. So it's not driven now. What I haven't discussed with some people have asked me, we could make a version of the T over X subtracting each of these one by one. That's a good way of saying people trust us. But better way people trust us. So only at the very top here we see difference. Simulation. Right? It's like all picture would be great and they or yeah, so I hope that answered some of your questions.
Thank you, Abdoulaye, for a very nice presentation. I really liked it. And the variable is very interesting. So the first question I have is that, is the paper available yet? Because if so, tonight I'm reading it. So,
Well,
so,
no.
so did I ask?
No.
So I didn't expect this question to be that tricky.
No, I mean, I can send it to you. No,
you can wait if you
we
like.
have
It's really nice. I mean the variable I think is, I mean the correlation is that itself is nice, but I think T over X and a consideration about that I found this very, very interesting. Now about the correlation, may I ask maybe two questions? Is that okay? So the first thing is about this correlation. So instead of GDP per capita, if we had, let's say, G per capita, I have the feeling that we may see a similar positive correlation. So what I have in mind is that a larger public sector size per person, due to maybe experience-related reasons, so we learn how to become more efficient, may generate this kind of a correlation. So, my first question is that, did you consider that? Did you take that kind of a relationship into account? If so, is that a positive relationship?
Yeah, so I agree with you that we might see something around this now. But you know, I think that would be a nice fact to show.
Yeah.
The only kind of limit where I would think of where the interest in G at least have often people think about it as like, oh, do we want to have a higher G or not? And we want to make sure that our paper is not about having a higher G, right? Because that's more people are often they're interested in like the short run fluctuation stuff.
Yes.
Where they're high G. But we can certainly show the correlation.
Yeah, and a related question I have is that, so in case there is such a strong correlation, then putting that in the model and thinking more maybe like a learning by doing kind of a setup where basically the government learns how to collect taxes more efficiently, and then in a Ramsey or a standard macro setup, what will be the implications could be interesting to study.
Absolutely, yeah. We have an exogenous TFP. There can be forces that are making it endogenous.
Yeah, especially the US history is I mean, this is of course cross-country, but the time series of the United States, like over time, the government growing, of course, GDP is also picking up, but also the efficiency picking up. That's very, very interesting, actually. Sorry, I took more than one question.
Thank you. That was really great. I have a question related to Augustine. So the US graph was very interesting because I think in the 90s and 2000s, where you have countries like going through this digital transition, you don't see that much of a blip. But I wonder if you do it for any developing country context, is it larger in magnitude? Is there a way that you guys can assess?
Oh, so you're saying digitization led to this?
I'm assuming that that's what might be going on there.
You're saying, if we did,
if
it
you
would be nice to have the historical data for the developing countries. Unfortunately, we don't have it, but
there's also the scale of this is so large, but if you did a zoomed in version, basically after the Second World War, this is a very old version of the same graph, but you do see these little, like at some point in the 60s, the IRS introduced
Withholding.
Instead of having paper forms, they just like automatically started processing returns, and you
Yeah.
see little blips that it's also just in part because the magnitudes are so large on the larger graph.
So a related point, so maybe even if you go to the cross-country graphs, you see a lot of variation within income groups.
Yeah.
And so I wonder if you can look at like, particular cases where a country did invest a lot in making that digital transition, if you see that explains some of the variation. Yeah.
Yeah.
I'm going to preempt John because I'm guessing this is his question. He got me on the last one. So your expenditure there is part of the social cost of collecting taxes because it's what the government pays the agency. But then there's another part of the story, which is what the taxpayers have to pay to comply.
Mm-hmm.
So an easy example is a country that's going to take the time to have pre-populated income tax returns. The administrators have to pay a lot.
Mm-hmm.
If you don't do that as a convenience for your taxpayers, they have to do all that work and
Like
pay for TurboTax and everything else.
Yeah.
So I'm trying to figure out is socially, it seems like you'd want that in the denominator as well.
Mm-hmm.
Of course, you don't have any data on it,
Mm-hmm.
but can you conjecture on how that might differ across countries or?
My best guess of how we could do that without having data would be to use measures of how much people pay for TurboTax and other things, and include that, right? That could be a way of doing it. Accounting services, yes. There can be certain like variation of our figure we can do on this dimension, yeah. 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 We can.
So I have one follow-up on that. Question that's different.
Different.
So the follow-up is just, there is some research on quantifying compliance costs of taxation, like Jack Cool, where there's surveying like business owners. You might be able to do that. My question is about your future work, right? So it seemed like your last point on your future work slide was you're going to try to match tax collections across countries with law. And so I guess the question is, would you be doing that assuming that countries are doing what would be optimal according to the Ramsey model?
Yeah.
And given what we heard last night, I would expect they're not doing what's optimal for the model. So it might be interesting to just quantify what's the discrepancy there. What's that?
Yeah, no, that's a great question. What is optimal versus suboptimal? I mean, yeah, as a more someone who's thought of this also, I think if you write a model that captures the reasonable phenomena, maybe we should think of political economic considerations as well. It should be then able to look at but even like I want to say, even with the model that I gave you, the optimal thing, even for a very efficient tax administration, is not just to go and have a very high tax. You still have a Laffer curve, and this Laffer curve is coming from distortions to labor, which is the usual one, welfare effects, and also the shifting from the modern to traditional sector. So, and we think that that's precisely important. So, yeah.
Okay, so I have one follow-up question. So these are sort of picking up on a couple of things that came up. Actually, two follow-up questions. One is going to this issue of optimal taxes and a point that I think Burak was mentioning earlier about learning by doing and so on and so forth. Have you guys considered sort of the idea of spillovers, that public capital might actually have increasing returns associated with it in terms of productivity gains in tax collection? Something that would kind of build over time, right? So that would bring in some of this endogenous kind of evolution of tax collection productivity.
Yeah.
And that would obviously have implications for optimal taxation.
Yeah. So, like, I think like in the history of growth, you know, we had you know, the standard, the solo model, and then you had the endogenous growth model, Romer. We were like, let's make this case first for people who are familiar with the solo model.
Mhm.
You know, like, you know, I think Tim Besley made the case first of compliance mattering and then having this dynamic effect to having more civil society mattering. Potentially in this project, potentially in the next paper, but endogenous
Mhm.
formation of skills in the tax administration is indeed important. And we will certainly think of that. For now, we made the choice of kind of convincing macroeconomics this matters by saying, hey, this is your neoclassical growth model, and look, this is what you're using. We change this thing, and this does matter. But I absolutely agree with you that that's an important phenomenon, especially with the digitization that makes both private sector firms and administration more productive. Okay, thank you.
Thank you, Abdoulaye. All right, let's thank our speaker, folks. So we are on break for lunch. CDE students and all faculty present and speakers, you're all invited. We will be making our way back to the faculty club where we had dinner last night, but lunch is going to be served in the basement level. So basically it's going to be in the same direction as where we had dinner, but if you folks notice, there's a stairwell heading downstairs right before the dining hall area. We'll just take those stairs down and lunch is going to be served in the basement. Our plan is to reconvene back here by 1:45 to have our afternoon session of talks. Enjoy lunch, everyone, and hope to see you guys back here at 1:45.
Standard one with a company.